The next couple of worksheets, I guess three that we'll take a look at, are going to be sales forecast and your additional inputs. The sales forecast can get a bit quirky, so kind of bear with me on that a little bit, but it works out usually pretty well. But for some of you, your products or services may be a little bit quirky and a little bit tough to fit into here. But we should be able to make it work. You just might have to kind of combine some things. And I'll give you an example. Um, let's say you wanted to order a coffee shop. A coffee shop may have all kinds of different items that it might sell, all the way from black coffee of three different sizes to the foo-foo drinks, the lattes and frappuccinos and crappuccinos and all those other things that I'm not familiar with. I'm kind of a black coffee guy myself, and may sell things like mugs and cups and other things and biscuits and who knows what, everything, right? And to try to fit all of those, and we've got 6 product lines. Okay, so what you might have to do in a case like that is just say, I'm going to average, right? So my product line might be coffee. This is going to be black coffee, we'll say. If I can type, I'll say black coffee. Kind of got my mic right in the way there, so it's a little tough sometimes. Okay. My units in that case are just going to be by the cup, right? My sales, here's where you might kind of have to average, right? Small might be $1 and a large might be $2.50. Okay, and I might have a medium that's going to be, $2. Okay, so yeah, most people are going to buy a medium or a large, so I might just say my average is going to be $2. Okay, per unit. Again, my cost per unit, if that's my average, I got the cup and I've got the coffee. It's not really very much, might be 45 cents. Oops, I got to put a 0.45. Sorry, cost per unit, 0.45. Okay, and that tells me what my margin is per unit then, right? And then I might have things like my frappuccinos. Is that even a drink? I don't even know. Frappuccino. And again, I might have different sizes, so I just got to I'll probably sell it by the cup or the mug or whatever the heck it is. I think those are a lot more expensive. You guys might know, $5. Cost in those is probably more though too, maybe $2. So I got a margin there, right? Then, I might, like I said, I might have cups and different things like that. So, I might just call those retail items. What's the units? Well, in this case, I don't know. Because I could be all kinds of different things that I might have that I might sell, right? T-shirts, baseball hats, whatever the case may be. So, I can just say it's going to be a 1. I don't know. It doesn't matter. Okay. Or items, whatever the case may be. Again, I just got to kind of have to think, what's my average? What's my average going to be of those items? Maybe $20. Okay. I know from experience that generally those types of items have about 100% markup, or they've got about a 50% cost of goods sold, so I can put in $10 there. Okay. So now I've got 3 things. I skipped one line. Got to be a little careful when I go down below, but it shows up here, right? So black coffee, and here's the things you got to think about, okay? and this takes some sense, because sometimes I will sit and do the math in my head, at least to see if it's rational or not. But I might say to myself, well, how many cups of black coffee am I going to sell? I might sell 10 per day. I'm open 6 days a week, so on a normal month, 4 weeks, it's usually a little more than 4 weeks, right? So I might say that I'm going to be open for 25 days. So if I were to sell 10 per day on average, and I'm open for 25 days a month, I'm going to sell, 250 cups of coffee. It does the rest of it for me, right? You can see it kind of adds this up, my total sales, my total cost of goods sold, and so my total margin. My Frappuccinos, I probably don't sell as many of those, and I might add, lattes or iced coffees or whatever too below that. And again, you might have to combine some of those. But my Frappuccinos, so I might sell 5 of those a day, and again, the same, 25 days in a month, so I might sell about 125 of those per day, right? Okay. My retail items, probably not so much. Those are probably just a little bit quirky. I might only sell a couple of those a day, right? Oops, a couple a day. If I do a couple a day, sorry, I've got 25 days, so I might sell about 50 of those. Okay. So now I can drag that out, right? If I want to. If I think my sales are going to be fairly consistent, I might say that in the summer, June, July, August, this might go down, right? Okay, might go down a little bit because it's hot and people aren't buying quite so many coffees, right? Okay, my Frappuccinos probably don't change too much because, well, if I got other, people get addicted to those, but if I've got some other things too, I might, cold fraps or whatever, might not be so bad. Okay, and my retail items, same thing. Throughout the year, those are probably going to stay pretty consistent, so I can drag that. Obviously, I would have probably had a few more things to sell. Again, a few more things to sell, like different types of coffee, different whatever the case may be. But I come down here to the bottom line then, and it says here my total sales dollar-wise about 25,000. My total cost of goods is about 10, and so my total margin's about 15. Now, what I want to do if I'm you guys is go back and look at, see what was my first year's payroll. Okay, and I might have to move my deal here so I can stretch that out a little. And I don't have a number on mine, but you guys will. If my first year's payroll is $15,000 and my sales forecast is that I'm only going to have a net margin of $15,000, and I haven't even added in my operating expenses, or I probably have a problem. Okay, so then I might have to readjust my sales forecast or go back and take a look at my payroll operating expenses. So you want to look at both of those. Now, would it be totally unusual to lose a little bit of money, say the first year? No. Okay, so it doesn't have to be perfect, and it certainly you don't want to, I don't think, get too aggressive either. Figure out kind of what you're shooting for, and try to make that, in this case, try to make that sales forecast fit. Okay, try to make it something that looks reasonable though, and will fit. So remember, we had operating expense. We had rent. My operating expenses might be $1,500 a month or $18,000. And what I say, my payroll was $15,000, so I got $33,000. Okay, I guarantee you this needs to be, my net margin needs to be more than $33,000. Okay, remember I still have to pay myself. Okay, different things like that, and so just try to make it fit a little bit. Take a look at those other numbers, make it fit. If you lose a little bit of money the first year, or even have a negative cash flow the first year, not completely out of hand, or not completely crazy on projections. Okay, second and third years, then you're going to want to take a little closer look at those as come along. So, okay, you get that first year done, it looks pretty good. You come to the second year, there's really not a lot that you have to do here in the second year. Okay, you can, these are golden, so you could come and mess with these numbers, but what happens here is they've got a growth rate from years 1 to year 2 and year 2 to year 3. You don't have to assume that same growth rate. Okay? You may think that your business is going to grow faster. It just depends on the type of business, and so you may want to change that to 20% growth rate both years. Okay, or you may think that your business is just a little bit more. For me, if I looked at a coffee shop, I'd say, yeah, my growth's going to be fairly modest. There's a bunch of coffee shops around. I might be lucky if I get 5% right. Okay, and it makes all the other adjustments for me. Okay, so as long as I plug in these two numbers, take a look at them. You may be happy with 10%, but take a look at them. As long as I plug in those two numbers, I'm good to go. Okay, next one, additional inputs. Let's take a quick look at that. We have accounts receivable. Okay, for a lot of our businesses, and I'll stick to my coffee shop example. If I'm going to do a coffee shop, I'm going to get paid right away. People are going to give me cash, a credit card, or a check. Okay, I'm not going to sell things on account like I might if I had say an auto repair shop. Okay, auto repair shop, a lot of people are going to pay you right away, but there's going to be, you might have insurance that you got to wait on sometimes. You might do some contracts for schools or for other companies, and so it's on account, right? And they're going to pay you 30 days later, that type of a thing. So you just kind of have to think how your own business is going to work there. Okay. So in my coffee shop example, I might keep it at 100%. I might also say, allowance for bad debt, it kind of plugged in after I changed that to 98. It just automatically plugged in, did the math so that this would come out to 100%. That might be realistic. I might get a bad check every now and then. I might, a few things like that could happen. So I may want to account for a little bit of like bad debt. Now, let's say I was doing the automotive thing or another type of business that might have some accounts. Okay. Then I might want to change this and say, about 60% of my people are going to pay me up front. Between 30 and 60 days, that's another 25. Okay. And then I got, maybe 13. And again, then my allowance for bad debts, 2%, 1%, could be 5%. Might depend on the type of business that you're in. Now, the thing that we have to be careful here is that this shouldn't change much from year to year. And I think, we can probably be pretty safe and say we'll be kind of consistent there. So if I drag those three down so I get a consistent look there, make sure we're at 100%. Okay, just make sure this kind of fits the type of your business. If you're doing a coffee shop and you're saying you're not going to get paid for more than 60 days, I'm going to send it back and say, yeah, you're going to have to fix that. And other types of businesses might be the opposite. Accounts payable is similar, right? Again, we have to be 100%. But how do we plan to pay our bills? Again, it might depend on the type of business that we're doing. If we're doing that same auto business, right, the parts store is probably going to give us 30 days. So we're probably going to pay a lot of our bills actually down here between the 30 and 60 days. Okay, maybe 75% of them, which might put us at only about 25% here. I think this time you got to make sure that it equals 100%. Okay, and once again, that's probably going to stay fairly consistent. So I might do that type of if an auto shop, even the coffee shop, right? I'm going to have food service and they're going to deliver my coffees and my cups and different things like that. I'll probably end up with an account. They might kind of want cash to begin with, but it might depend. If I've got good credit with my bank and whatnot, they might be happy to give me a little bit of credit. So take a look at your business. You kind of decide, make sure you got the 100% there. You come down here to the line of credit assumptions. And this says, do you want to have a minimum cash balance in your bank account? Some banks will require that, actually. Especially for businesses, they might require that you maintain a certain cash balance. But in this case, this is up to you. And some people say, I just want to have $1,000 just to be safe. I want to always keep that. And what this does is that on your cash flow, when we get to the cash flow, is that if you fall below that $1,000, it will actually assume that you have a line of credit, and it will advance money from that line of credit to keep you above that $1,000. You might like that kind of cushion. 8% might be a little high right now, okay, for interest rates. Prime rate's about 3. Normal rate for a lot of businesses is going to be 5 to 6%. I might change that to 6. Okay, got that. Now we come down to here. Additional fixed asset purchases. Your fixed asset purchases from your starting point should show up here in month 1. Okay. For the vast majority, if not all of us, we're not going to have any more purchases, right? fixed assets. Remember, that's equipment, furniture, fixture, vehicles, those types of things. If you're projecting that you're going to buy a vehicle back there on the starting point, you're probably not going to plan to replace it or add another vehicle in the first year. Okay, that might be a little bit optimistic. Um, if it happens in the third year, possibly, okay, you can add those down here then, yearly total. So this would be monthly total, or monthly amounts, um, and these would be the yearly ones here. So most of us aren't going to buy any more real estate. It just doesn't make sense. Might we make some other leasehold improvements? Yeah, maybe. Maybe at the end of the first year, maybe in year 2, maybe in year 3. If you want to estimate some of those amounts, that's fine. Equipment, furniture, same thing. Typically, in the first 3 years, we probably wouldn't project much activity here. Again, some of you in some of the businesses that you might have, if you're a mobile mechanic, I don't know if I had anybody that selected that type of a business. You might. I mean, you're going to be maybe constantly adding some different equipment, or in year 2, you may want to add some different services, and so you're going to need some different equipment where you could project then the purchase of that equipment, and that would be fine. Effective income tax rates at 0, it shows. That's your guys' probably shows 20%. The new version shows 0, I think, is a default, and 0 should be the default. 0 is what you should change yours through. Here's a little bit of a teaching moment, and that's saying that for the types of entities for most small businesses, okay, the types of entities that most small businesses choose are called pass-through entities, which means that the excuse me, the profits and losses of that business flow through or pass through to the owners. The business itself doesn't pay taxes. Okay, it gets all done. The business gets all done. It files sometimes an informational tax return, or if it's a partnership or an LLC, and then it provides a K-1 to the owner or owners. What was I going to say? If it's a sole proprietorship, that's just calculated on a Schedule C on the tax return, okay, and gets filed in that fashion. And again, the owner pays the taxes on all the profits, or gets the benefit of all the losses, if that is a benefit, okay. Otherwise, so the business itself doesn't pay those types of taxes. So we change that to 0. Exception here is C Corps. There are other exceptions, but that gets to be a little more complicated than what we want to go to now. If you take tax law, you can learn that from Laura or somebody else maybe. C corporations are an exception. They do pay taxes. Okay, there are tax provisions set up in all states and the federal government for C corporations. Okay. In some cases, there are some advantages to doing a C corporation, even from a tax standpoint, but we're getting a little more complicated than what I want to get to for class. I do want everybody, please, I know this is the end of the video. Hopefully you've listened this long, and hopefully you're paying attention. If you're half asleep, please wake up and change the amortization period to 1. Okay, again, kind of a teaching moment for me and for most of the small businesses, and I tell you to keep it simple. We've come up with some startup costs here. Okay, these ones down here, and what we have to do is amortize those costs. We're allowed to amortize those over a few years, presumably, at least according to this. I don't know that that's very practical. I think for most of the types of small businesses that we're talking about, they're going to go ahead and take or expense those out in that first year. Okay, they'll amortize it over 12 months versus 24 or 36 months. And I think that's more practical, and so that's why I have you change that to 1. So please do that. Okay, so we've taken a look at the sales forecast for the first year, 2 and 3, and also the additional inputs. If you got questions about any of those, let me know as you're going through it. Thanks.